When overinflated home prices deflate, and do so for years, there are many losers. One of the top overinflated markets is San Francisco, where a median single-family house cost just under $1.4 million in January. Now that's down 19% from the peak in February last year, when the median house price had inexplicably spiked to a ludicrous $1.7 million. I mean, what were these buyers thinking? That marks a decline of $320,000, a big chunk of change to lose in 11 months on a median house. Note, these are not palaces. Median means half of the houses sold for more and half sold for less. It's the middle. These median prices are very volatile, but if this pattern drags on for years and prices bounce up and down on a downward slope in an orderly fashion rather than all at once, and if this happens in enough overinflated markets around the country, then they're eventually coagulating into a broader rather than just a local housing bust. There are many losers in this scenario, as we have seen in past housing busts, but it always boils down to this. Regardless of how thin you cut a slice of bologna, it always has two sides to it. And the other side of this slice is an entire generation of young Americans and many thousands of companies and millions of jobs beyond finance and real estate that would be huge beneficiaries. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, February 24th, 2019. And we're going to look at the other side of that slice of bologna. First things first, among the losers of a drawn-out housing downturn are the usual suspects, as we have seen during the last housing bust. There are the shadow banks and the investors that have specialized in riskier mortgage lending. Banks, bank stockholders, and perhaps some bank bondholders stand to get a bloody nose. Guarantors of mortgage-backed securities, such as our government-sponsored enterprises Fannie Mae and Freddie Mac, or our government entity Ginnie Mae, and thereby taxpayers, may take a hit. Property tax revenues take a hit. This might impact things like school funding. A special surprise will be waiting for units of big banks that have focused on issuing very large mortgages to fund the home purchases of freshly minted startup millionaires whose wealth and income depends on shares that are not yet publicly traded and whose value could go to zero as the company runs out of funding and shuts down. Homeowners and investors who bought in recent years near the peak or who did some cash-out refinancing near the peak are suddenly confronted with some very unappetizing options, and so on. These are well-documented processes that play out over the years. This type of housing downturn kneecaps the established wealth in a myriad ways. That's why housing got a huge bailout from the Fed last time via QE. No one wanted to see that established wealth, mostly stockholders and bondholders, become less established. The Fed moved heaven and earth to make these folks whole, and then some. It purposefully attempted to create what it called the wealth effect, where asset holders get wealthier. And this has succeeded wonderfully. Ben Bernanke, as Fed chairman at the time, explained this in a now infamous editorial in 2010, published by the Washington Post. But here's what happens on the ground when the price of a house surges. And we have measures for this. The Case-Shiller Home Price Index, for example, one of the most quoted housing metrics in the U.S., measures the price movements based on sales pairs. When a house sells in January, the Case-Shiller Index compares the selling price to the price of the last sale of the same house, say 6 years earlier. It does this with many houses in each market that it covers. In other words, it compares the number of dollars it took to buy this house in prior years to the number of dollars it took to buy this house in January. So the selling price might have doubled over the multi-year period, but the house essentially stayed the same. It just got older. It didn't double in size. In fact, it didn't gain anything. It's the same house. What has changed is the purchasing power of the dollar needed to buy the house. This is a type of asset price inflation where the same assets required more dollars to be purchased. Asset price inflation is like consumer price inflation, except it applies to the destruction of the purchasing power of the dollar to assets. When home prices rise, it's mostly just home price inflation, meaning that the dollar loses its purchasing power with regards to homes. That's all we're seeing. What the Fed created with QE was asset price inflation, and in the housing market, home price inflation. The same dollar is buying less. But there is a problem for the economy and the people in it. Wage earners earn these dollars, and wages have risen but only a little, even as home prices have surged year after year. So the purchasing power of those wages has been crushed with regards to the buying of homes and other assets. In doing so, the Fed crushed a whole generation of wage earners and potential home buyers. It permanently damaged the economy, strangled consumer spending on things other than finance and housing, and ripped to shreds the American dream of many young Americans. Housing is one of the reasons why finance is such a large part of the U.S. economy. A housing bubble is of enormous benefit to the financial sector, its shareholders and bondholders, and the bonus recipients and executives. They are among the biggest winners. But in the process, the surge in home prices has created what is called variously the housing crisis, which is the name for it in San Francisco, or more broadly, the affordability crisis. The IMF and others like to use the term affordability crisis. This is when the purchasing power of labor has been crushed with regards to housing. Housing is not a playthingy like stocks. It's where people live. And if the fruits of labor do not allow them to live inside a home, they do what exactly? Live in their cars? Indeed they do. They have full-time jobs and perhaps 2 jobs in a household, and they cannot afford to live in even a basic home. That's the definition of the housing crisis. The housing crisis has been caused by asset price inflation that way outraised wage inflation to where the fruits of labor have been crushed. It's that simple. Now, the other side of the slice of the bologna. If home prices decline for years in an orderly, slow fashion, rather than all at once, it would convey large benefits to a big part of the overall economy beyond housing and finance. The IMF last week published a note on Australia's magnificent housing bubble that has been spiraling down since late 2017. And I quote because this hits the nail on the head. Economic and financial vulnerabilities relating to high household debt and low housing affordability have become major concerns after Australia's recent housing boom. So let me repeat this. High household debt and housing affordability have become major concerns after Australia's recent housing boom. The IMF goes on. The forecasts incorporate a soft landing in the housing market, but a stronger market correction remains a risk, the IMF said. Under an orderly correction, house price overvaluation and average household debt both decline over time, the IMF said. So this housing downturn would not only whittle down the risks to the financial sector over time, but it would also, as the IMF put it, restore housing affordability. That's a good thing, the IMF suggested. That's what Australia needs, it suggested, as long as it transpires gradually over the years and not all at once. This principle applies to all overinflated markets. As home prices fall, the affordability crisis eases. A 5% or 10% drop isn't going to be of much help, but in markets such as the most expensive markets on the West Coast, a 30% drop or 40% drop playing out over many years will perform miracles for the younger generation and a big part of the economy. These younger Americans are already burdened by nearly $1.6 trillion in student loans that come with atrocious default rates. And these younger Americans are looking at a housing market that is for many of them totally out of reach because the purchasing power of their labor, the dollars they earn, has been crushed by rampant multi-year home price inflation in those markets. I'm not talking about markets where the median home costs $200,000. I'm talking about markets where the median home costs $400,000, $500,000, or $1 million. Restoring the purchasing power of labor with regards to homes is precisely what a long drawn-out, more or less gradual housing bust accomplishes. When home prices drop enough, people with decent jobs will be able to afford decent housing. and gradually the housing crisis or affordability crisis softens. A gradual, long-drawn-out housing bust has another massive benefit for the economy. It allows homeowners that bought at these lower prices to spend more money on other things. Their budgets won't be entirely eaten up by housing costs. And if rents move lower in response to those dynamics, renters have more money left over to spend on other things. Industries beyond real estate and finance will benefit, from automakers to restaurants. Destroying the purchasing power of labor with regards to assets and particularly homes is a pernicious thing for the economy and for people who work for a living. Restoring some of the purchasing power of labor with regards to homes would be of a large, long-term benefit to the economy, even if established wealth takes a hit. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.